All right, let's go ahead and get started here. This is Chris Atkins at C2FO speaking. Just to make sure everybody can hear me, Mike, can you hear me?
Yes, I can.
Great, appreciate it. So yeah, like I said, let's go ahead and get started. I know people are still rolling in. If let's see, can't if you can't hear or have any questions about the Zoom or the PPP program, there's a Q&A function and a chat function where you can chat with the co-hosts if you're having any Zoom problems or ask any questions, which we do have a Q&A portion here. Mike, Ashish, and I, and all of us at C2FO really appreciate you joining for this webinar. We think you'll find it highly informative, as Ashish and I have found it, when talking with Mike. But first, let's do some introductions real quick for the three of us, and then we'll get on to Mike's presentation and then further to the question and answer session. So Mike Royle is a practicing attorney and has been representing corporate and banking clients for about 30 years in the banking industry primarily, but also corporate. Mr. Royle represents regional, national, and international lending institutions and commercial loan transactions. And in fact, he's the attorney that we use primarily on our capital finance side for arranging those transactions. He works with lenders and borrowers on ABL agreements, loan and security agreements, subordination, intercreditor agreements, participation agency, and other complex lending documents. And so when we look at the space, and then also he's very up to speed on PPP and other government programs, he was the expert that we hope to tap for this webinar. Ashish, who is the C2FO capital markets head, joined us last summer. Prior to that, he was at SoFi running capital markets, raising billions of dollars for their operations and funding. He was responsible for their balance sheet, their securitization, structuring, loan sales, and their warehouse facilities. And he began his career at Deutsche Bank, where he spent 13 years, most recently as the managing director and head of structured products and product sales. Again, my name is Chris Atkins. I'll be your host for this afternoon, and my background is in commercial banking for a regional bank out of Colorado called First Bank. Then spent about 6 years in private equity, and have now spent almost 4 years in fintech. Currently as the head of our capital finance practice, where we do ABL and factoring facilities for suppliers within our network. So again, I do want to say, if you are having any trouble hearing or have any questions about the Zoom, there's a chat function on the bottom of your Zoom panel where we have 6 co-hosts here that can help you out with any issues you might be having. And then if you have any questions for the Q&A session, there's a Q&A button that will alert us and put those in the queue. But let me real quick before handing off to Mike, set the stage a little bit. So, obviously you're tuning in. We have a few hundred people here that have tuned in because these are wild and unusual times. Many businesses are feeling the impact of the business shutdowns across the U.S. In varying capacities, obviously left up to state and local agencies. Only essential businesses are open in most non-rural areas, and what we're seeing out of unemployment reports, the kind of the back of the napkin math, is that we're seeing unemployment that's nearing or greater than 20%, which we haven't seen since the Great Depression. To that effect, the federal government has provided more than $2 trillion of aid here. Some of which is more in Ashish's wheelhouse, where they're funding bond purchases and government purchases, government debt purchases, and others are things like the PPP program, which we're going to talk about today. As you are undoubtedly aware by tuning into this, the Senate passed another $310 billion in PPP funding for the House to look at, which we expect to pass on Thursday and be signed into law. And there's, that's kind of V2 of PPP, and there's a lot of lessons to be learned, some of which are incorporated, and many of which we will in PPP2, and many of which we will talk about here during this webinar. So with that, I'll hand it off to Mike, who's got a short presentation prepared, and then we'll hop into the question and answer session. So go ahead, Mike.
Sure. Thanks, Chris. Let's start off first by, as I'm laying the groundwork here, we're in the framework of the Small Business Administration 7A loan program, which existed, 20, 30 years ago. It's been around for a long time, and it's the mechanism that the government and Treasury is using to push this money through the system. As Chris mentioned, now it's going to be, after when the next phase passes, it'll be roughly $660 billion. So we're using that infrastructure. So many of you have had experience with the SBA 7A program, and all that we're talking about today from the CARES Act, which amends the current SBA 7A program, and we'll refer to the specific provisions as the Paycheck Protection Program. So I'll say PPP. That's what I'm referring to there. I want to also distinguish, many of you on this call probably are familiar with the Economic Injury Disaster Loan. EIDL is the acronym we use on that one. That's different than the PPP program. It has been in existence. It was modified on March 5th, but what we're going to focus on today, we can entertain questions, and there'll be some discussion about the interplay between the two, but we're going to focus on the Paycheck Protection Program, which is a subset of the CARES Act that was passed on Friday night, March 27th, so it hasn't been around that long. The first test that you have to consider is whether you're an eligible participant. A sole proprietor, independent contractor, a self-employed person, a not-for-profit organization, which is different from typical SBA statutes, veterans organizations, and there's a tribal concern. But the primary focus is on a small business. So what you do is the test for the PPP Act is whether you have 500 or fewer employees. And that's a broad definition of employees. That includes part-time employees, full-time employees. So you would total up your determination to see whether you qualify for a PPP loan by determining whether you're a small business, 500 employees or less. Now, if you have more than 500 employees, there are three separate ways you can still qualify. Obviously, if you're familiar with the SBA employee-based size standards that existed prior to the crisis, in that case, you would look at your North American Industry Classification System code. Every company has one, and you would look at that code and determine whether you were a small business based on the number of employees you had. For instance, there are examples in aerospace and other industries where that number can be as high as 1,500 employees, and you'd still be deemed to be a small business. So that's an exception to the 500 or less employees test. Many of you are also familiar, if you have a NAICS code of 72, if your code begins with the number 72, you are also exempted from the 500 or less employee test. The second way, that's an exception to the 500 or less employee rule. The second exception is a revenue-based size standard. Those existed, again, prior to the enactment of the PPP CARES Act. And if you happen to qualify under those, in essence, you could have more than 500 employees and still qualify. Subsequent to the enactment of the law, Treasury has issued guidance that provides a third exception. I refer to it as the alternative size standard. And there's basically four elements to that. Again, this is assuming that you're over 500 employees and you're still intending to qualify for the PPP program. And that's really four elements to that. You have to be an operating business located in the United States. And on March 27th, 2020, your maximum tangible net worth could not be more than $15 million, and your average net income after federal taxes, but not excluding loss carryovers, for 2 full fiscal years could be not more than $5 million. So I refer to that as the 5 and 15 million exception. So there are, the first initial test is, do you have 500 employees? And all the SBA affiliation rules that existed prior to the enactment of the PPP Act still apply. So many of you have waded through those 21 pages of guidance. It is very complicated, but what the SBA is trying to establish is if they're trying to limit it to small business. So I used an example of the private equity law firm that has, say 10 businesses, and they have 200 employees apiece, and they control all 10 of these businesses. The same firm does. Well, when you're determining whether you qualify for the 500 or less employee test, you have to aggregate all 10 of those companies. So you'd have 2,000 employees in my example, and therefore you wouldn't meet the 500 employee test. There also is an exception for an SBIC. If you happen to have an SBIC loan, that might also be an exception. So let's now assume that we qualify for the PPP loan. How do you determine your loan amount? Well, it's a process it's a look back. You take all your payroll costs, which is a very broad definition in Section 1102 of the Act, and it picks up everything that salary, wage, commission, or similar compensation, which I consider bonuses. For your restaurants, it's payment of cash tip or equivalent, payment for vacation, parental, family, medical, or sick leave, allowances for dismissals or separations, payment of health care benefits, payment of retirement benefits that are paid by the employer. And also there's, it's everything really except FICA. That cannot be part of your payroll costs. And when you're determining your payroll costs, you're doing your 12-month look back. You look back 12 months, or you can use your 2019 payroll costs. But you want to make sure that you limit it to $100,000. For employees that make over $100,000, there's a cap. So when you're calculating your payroll costs, you can't include salary, wages, and commissions in excess of $100,000 on a per employee basis. So you calculate all of your payroll costs, you look back 12 months, you calculate it, and then you divide it by 12 to ascertain the average monthly cost. Then you multiply that number by 2.5, and that's the maximum loan amount that you can have for the PPP loan. I think there's a lot of questions that we will get later on, but I just want to make sure it's a broad definition of payroll costs, and you'd want to include most everything except FICA, as I mentioned, and we can go through the nuances of the $100,000 per year per employee cap if you want to later. But I want to kind of keep moving a little bit here, and now I want to get to what I call the third element. We've now determined that we're eligible for the PPP loan. We're having 500 or less employees, or we meet one of the exceptions I mentioned. We've calculated our loan amount. We did the 12-month look back, divided by 12 times 2.5. We figured out, okay, this is our loan. And now we're going to make the application. You go to the lender that you're most comfortable working with and have a relationship with. And Chris is going to touch on that in a second, on other options if you're having difficulty with that. Of course, there's a lot of publicity out there now where prospective borrowers are having difficulty getting their applications submitted through their SBA lender and up to the SBA, and Chris might touch on that here in a little bit. But now that we've got the first two elements, I want to talk about what I think is the most important aspect. Everybody hears about the forgiveness component or the forgiveness feature of the PPP loan program, and it's exciting in the sense of it is your loan amount that we calculated. If you spend it on specific expenditures, and this is going to be strictly enforced. You can apply after June 30th. There's going to be an application process that hasn't been developed yet, but it'll be published in the next 2 or 3 weeks. But after June 30th, you'll be able to apply for debt forgiveness. But in order to be able to apply and to qualify, they have strict guidance that has been issued that basically it's for payroll costs that we talked about in our calculation, but it's 75% of the PPP loan proceeds have to be spent on payroll costs. That's very important. That's not, for all of you that are out there reading the law, the statute that was passed on March 27th, you'll note that's not in there, but this was issued in subsequent guidance. There's been approximately 7 issuances of guidance and interpretation since March 27th. So this is a moving target. And quite frankly, tomorrow or the next day, there may be additional guidance which would alter the things that I'm telling you today. So keep that in mind also, that it is a very fluid situation. But again, payroll costs, mortgage interest payments, rent payments, and utility payments. So it basically has to be for mortgage that existed on February 15th, 2020, lease payments on rent for leases that existed on February 15th, 2020, and obviously for utility payments that you had already, you're monthly incurring prior to February 15th, 2020. And it's very strict on what you can spend this on. And there are stories already circulating where people did not strictly follow the rules here. It's in specifically section 1106. And I think they're going to risk jeopardizing the forgiveness feature, which I think everybody's most concerned on. And that's why one thing I want to emphasize today is that we're not going to do that. We're going to strictly follow these rules. And this period of time that you spend the payroll costs, the mortgage interest, rent payments, and utility, it's an 8-week period that begins on the date your PPP loan is funded. And it's a hard stop after 8 weeks. And it's going to be for these 4 expenditures, always subject to the 75% payroll test rule, that were actually incurred and paid during this 8-week period. Now, I emphasize the incurred and paid because I'm hopeful that Treasury will provide additional guidance with respect to that component, because obviously we have, I give an example, just yesterday I had a client that had a $200,000 payroll. They had just funded their PPP loan. They were going to make a $200,000 payroll payment with the PPP proceeds. And I said, well, hold it. When did you incur that payroll? And it was 2 weeks ago, prior to the beginning of the 8-week period. And then again, carefully, if you look at section 1106, I think it's B, it says incurred and paid. So I hope there's guidance on there, but I think I saved the person from losing $200,000 of forgiveness if they would have paid for payroll costs that were incurred at a time outside of this 8-week period that we're talking about, which begins at funding and ends exactly eight weeks thereafter. There are limitations to the forgiveness. The statute goes into those limitations, and the guidance really hasn't been issued regarding the specifics, but I will say if they do a measurement that basically it's a fraction, the numerator is the average number of FTEs, which is full-time employees, not defined by the SBA, but is in the IRS code, which is different than your employee calculation. What we talked about earlier, the 500 or fewer employees. That's one of the frustrating parts of the statute. It uses terms and defined in different manners as you go through the statute. For the forgiveness component, not whether you qualify component, we're going to use the term FTEs because that's what's referenced in the statute. And you determine your FTEs on a monthly basis for the time period for your, what I'm going to call the covered period, your 8-week period. So you go your 8-week period, how many full-time employees do you have? And come up with a monthly average. And then you compare that with the monthly average of the full-time employees that you had on February 15th, 2019 to June 30th, 2019. What they're trying to do is compare the monthly average during your 8-week period with the employees that you had last year. Here's a key component though. It says when you're calculating your FTEs, and obviously you want your numerator to be larger than your denominator, and the numerator obviously is the FTEs during the 8-week period. But you do not include FTEs that were terminated between February 15th, 2020 and April 26th, 2020, so long as you hire them back by June 30th, 2020. And I'm throwing a lot of words at you there, but I want to, that is the numerator. And then obviously your denominator is the number of FTEs you had, as I gave you the dates, February 15, 2019 to June 30, 2019. So you apply that formula, that fractional formula to your loan amount. Hopefully, again, the numerator's larger than the denominator, so it's above 1, and you can then, it won't reduce your your loan amount for forgiveness purposes. There is also, there's going to be guidance issue on this. It's not as clear, but if you're planning on reducing compensation or salaries to your employees, so long as you do not reduce their compensation by more than 25%, there'll be no negative impact with respect to the forgiveness element. Again, the items that I'm talking about now have to do with reducing the amount that's being forgiven. And the forgiveness feature, as everyone knows, and you've been reading about it and hearing about it, is basically tax-free. There's no federal income tax recognition to that, which makes the feature wonderful because it appears to me that you can deduct your payroll costs that you incur during the 8-week period. So that reduces obviously your taxable income. And then the government, if they forgive the debt, which is not tax-free, it's a wonderful thing if it happens. But again, we're hearing a lot of things out there. We had one instance already where a borrower apparently wasn't following the strict language in the statute. They accidentally had their PPP loan funded into an operating account. I presume they had some type of ABL arrangement. The accounts were swept daily. The PPP loan proceeds were deposited in the account. It was swept, and almost a $7 million loan in that case. And it can be argued now that their entire amount was used for an unauthorized purpose. Therefore, they have lost the ability to apply for forgiveness. We're working on that. You know, we're going to try to put what I always say, Humpty Dumpty back together again. But if someone takes a close look at it, I think that it can be fairly assumed that they used the entire proceeds, the PPP loan proceeds, for an unauthorized purpose, and therefore will not be able to take advantage of the very important and attractive forgiveness feature. Again, it's not the end of the world necessarily. Recall that it turns into it's an unsecured term loan with no guarantees, obviously no collateral, that accrues interest at 1%. The first 6 months are deferred. So, but it is a fully amortizing loan from month 7 through 24. And many of you that looked at the statute that obviously was passed on March 27th, it referred to higher interest rates and a longer term, but the guidance that was issued after the law was enacted basically limited it to a 2-year loan. The accrues unsecured loan, term loan, 2 years, 1%. So in your worst case scenario, the takeaway that I want everyone to hear today is, you know, properly calculate, make sure you qualify, and all these affiliation rules apply. So if you're owned by another entity that owns 2 other businesses, you add all these employees together, calculate your loan amount, but it's a broad definition of payroll costs. And then when you actually receive the PPP proceeds, I can't emphasize enough how careful you need to be with respect to how those proceeds are utilized. I want everyone on the line to achieve 100% forgiveness of their debt and live happily ever after. And again, it's not the end of the world if you don't, and it's really tricky because there are permitted expenditures under the PPP loan program that are in sections other than 1106 that are okay. You can spend money on these things for interest on, say you have a revolving line and so on. But there's a distinction between interest on debt that existed on February 15, 2020 that you can pay for, but it's not forgivable. It's only mortgage interest. And when they say mortgage interest, that kind of throws a curve to me because I think of real estate. I mean, that's part of it. But so if you have a mortgage on a warehouse for your company, that interest component only, not principal, only interest, is considered mortgage interest and is one of the safe harbor categories that I'm talking about. Or if you lease equipment, obviously the lease payment, but let's say you borrowed money to purchase equipment. The interest component of that debt, equipment loan, the interest component is also part of the what I call mortgage interest exception that qualifies for forgiveness. It's very subtle, and you have to read it a couple times to catch it. But again, I want to emphasize being very careful on how you use the proceeds for the PPP loan. It's absolutely critical, and it's something we now are adjusting almost our whole presentation to just this third element. So that's why I've kind of probably gone over my time here, Chris. But I just want to, I can't emphasize how important it is to strictly follow specifically 1106. And there will be guidance. It has to be supposed to be issued prior to April 26th. Obviously, today's the 22nd. But the next few days, we'll get more guidance on some of the particularities about the strict interpretation of the four categories, which are payroll costs, 75% test, mortgage interest payments, no principal, rent payments, and utility payments. It's pretty straightforward in the statute. That is the overview. Of course, there's much more detail, but I wanted to kind of turn it back to Chris and see what we have some other people that are going to provide information.
Yeah, thank you, Mike. So it was a really good overview. The questions are pouring in. I'm starting to see some themes. And so, but first, let's do real quickly, just kind of a little bit of a strategic discussion, right? So lots of policy and then a ton of questions in terms of, how about, some of the broad themes you can be thinking real quick, Mike, are 1099s, cash versus accrual basis, like, how it's spent, and then timing. And I'm going to try and summarize those while Ashish is speaking so we can get to those. But Ashish, if you'll just give us a little bit of view from your standpoint, on the policy, capital markets, availability of funds, stuff like that you have a good view on.
Sure. Hi, everyone. I'll try to cover this pretty quickly because there's a lot of good questions coming in, and we want to make sure that we can address everything. So on Tuesday, yesterday, the Senate passed $484 billion in new pandemic relief funds. $320 billion was earmarked for PPP. The key distinction on this tranche, too, is that it did a better job of addressing allocation of PPP funds. And so what I mean by that is this bill sets aside $30 billion of the loan funds for banks and credit unions with 10 to 50 billion in assets, and also an additional $30 billion for smaller institutions. And this was really an effort to address the fact that small businesses were not getting all the cash that they needed in the first iteration. So some statistics on the first tranche that put this into light and the improvements that Congress needed to do. So 100% of the funds was accounted for across 1.6 million applications, and that suggested an average loan size of over 200,000. So for everyone's reference, there's roughly 6 million small businesses in the United States with less than 500 employees. And to give you context, businesses with less than 20 employees account for an amazing 90% of that total. Of the first tranche, 60% of the volume went to 3 large lenders: JP Morgan, Bank of America, and Wells Fargo. All the banks are doing their best to handle the flow of applications coming in. But the system and the banks can only handle so much. So one bank publicly put out data on the loans that they provided, and they broke it down by commercial banking customers and small business. And so for this one bank, nearly 5,500 larger commercial banking customers applied for the loans, and almost all of them got the loans through the program. And most of these commercial banking customers were existing customers of the bank. 6% of smaller business loans got approved for this one bank. So clearly, the first iteration needed improvements, and that's why Congress allocated funds differently, and also why you saw some other players like fintechs allowed into the program. Other points on the PP loan allocations that I thought were interesting, then I'll hand it back to Chris. 70% of the PPP loans were less than 150,000. In terms of industry breakdown, the crux of it, 14% was construction, 12% professional services, 12% manufacturing, 8% retail trade. Those were the largest groups. Also about 8% accommodation and food services. And this was an alarming number to me, and hence some of the improvements. 60 billion of the loans were between 350,000 and 1 million. I would have thought more, they clearly needed to do a better job of addressing small business, which they're working on. And in terms of future programs, I think some of us saw the Stephen Mnuchin interview last night. He said he envisioned this potentially being the last. I think TBD on that. I think they'll see how the program goes. I would imagine the funds are accessed quite quickly, and hopefully Congress goes back and does a good job for U.S. business. Chris, I'll hand it back to you.
Thanks, Ashish. Super helpful. Yeah, so before we run into the Q&A portion of this, and obviously tons of over 50 questions, so really appreciate the engagement. I hope we can get to at least most of the themes. Yeah, just from from what we're seeing in the market, again, I run our capital finance business, which does factoring and ABL, lines of credit. And what we're seeing in our portfolio is folks are very interested in the program, and we think that they should be, even as their lender. You obviously have to play by the rules, right? And one of the difficult things about a lot of this legislation is it was done very quickly, right? And so some of it's just less defined, right? I'm seeing a few of the questions, in the Q&A section, wanting more clarity around forgiveness, and unfortunately some of that is just forthcoming, and so that's just something we're gonna have to deal with, and is okay, in the grand scheme of things. But one of the big sticking points that we're seeing is the application process. And obviously, the big banks didn't have a ton of time to prepare for it, but as Ashish just mentioned, they also did a bulk of the dollars of funding. But one of the things that we're hearing pretty broadly is, I bank with, such and such large bank, and, haven't heard back from them, or haven't been able to apply, or, on and on, basically haven't been approved, which can be, really difficult for a small business that, picked a large bank for the capability of that large bank, but then, now feels a bit too small to get attention when they need it. And so what we're seeing, we're seeing progress and success for suppliers, within our network, and borrowers on the capital finance side, who are going one of two routes. The first is kind of the small local bank up to the regional bank. Folks like UMB or Commerce, here in the Midwest. First Bank, like where I started in Colorado. There's a ton on the East Coast and in your town. We're just seeing that they're pivoting more of their business. They're able to pivot more of their business to processing these, and are able to have some bandwidth there that the big banks just are a bit too leanly staffed to do. We're also seeing, the second part is that there's a number of fintech lenders that have pivoted their business to this model. And so, folks like our sister company, Cabbage, has received funding from one of our funders, and then also one that we're close with called Bluevine. And so, folks like that, and there's other ones. I think Lending Club is playing in the space also. But what they've been able to do, because they're highly technical, is they've created an online application that actually answers a decent amount of these questions, or at least vets it out through their application process. It's an application process that I've seen demos of and been through the process on for a side interest, and it's pretty slick. And so we've established a partnership with Bluevine, to help our suppliers in our portfolio to get through, and they're seeing applications that are complete being approved and funded back when the funding was turned on in as little as hours. And so I would encourage everybody to apply, just like what Mike said, because if you play by the rules, this is it's not even equity money, it's free money. So I encourage you to apply, but obviously got to keep an eye on the rules, do your diligence there, and obviously you're doing that by being here. On the topic of applying it at multiple places, because that is one of the questions. Obviously we wouldn't recommend that broadly, because that's against the intention. But I think it's really important if let's say you've applied at a big bank and you haven't heard anything, try and reach out and see if you've been processed or approved. And really the important thing is whether you've been provisioned in the system called E-Tran. That's like electric transactions, so E-Tran. If you haven't been put into that, then applying somewhere else would not necessarily hurt you, right? So it's really, E-Tran is kind of the first to file method to register with the SBA to get you going. So if you're stuck at a big bank, I would try and do the right thing and get in touch with them, but I wouldn't let the opportunity pass you by, and would reach out to a local bank or a fintech to get that done. All right, so we're at 70 questions, so let's jump into that. So first, Mike, a big portion.
Chris, let me just follow up on that one point. You're absolutely right. Your advice is very good, but if you're an eligible recipient, I think Chris mentioned, but you need to pull back the application, because if you have two applications pending from two separate lenders, that could be problematic. It's not a bad thing. It's just that you obviously can't receive two PPP loans for the same purpose. That is a problem, and obviously Chris making it clear you can't do that. But I think his advice is very good, in the sense of that's been a lot of what I'm hearing out in the marketplace. But I just want to make sure that an eligible recipient is part of the application process. They're going to ask you whether you have an application pending, and I would take the approach that Chris has taken. And if you feel like you're in purgatory, then withdraw the application and go to maybe one of the fintech options that Chris is suggesting.
Yeah, good clarification. Appreciate that, Mike. Because you obviously getting two loans here would be bad, and then you'd have to track down how to get the money back. So you definitely don't want that. All right. So one of the big themes here, Mike, is defining an FTE. So can you help us understand, does a 1099 qualify, and then further, how do like commissions and bonuses play into payroll costs?
Okay. First off, when you're calculating your eligibility for how many employees you have, that's full. It's a very broad definition. It's full-time, part-time, but it does not include independent contractors. So if you're talking about 1099, I want to make sure we distinguish that. That's not a count of your employees. The government feels that the independent contractor should make a separate application for its own PPP loan and should not be included in if you're an applicant or eligible recipient, do not include when you're calculating your payroll costs and determining your 500 or less employee analysis, include part-time and full-time, but do not include independent contractors. And FTEs, full-time equivalent employees, it's defined in the IRS code. We're going through that right now. I expect more clarification to be issued on that, because, as I mentioned earlier, the defined terms in the Section 1102, as you work yourself through the statute, you'll notice covered period means 3 different things, depending on where you are in the statute. Employee means at least 2 different things, depending on where you are in the statute. But if the question that Chris is getting at is distinguishing FTEs or full-time employees, the way I look at it in the IRS, there's a definition out there. It's not in the SBA provisions that I'm aware of, but I think you can rely on the IRS definition. 2 part-time employees could equal 1 FTE, essentially. So you include everyone, but the calculation, unlike the number of employees in the 500 or less test, that part-time employee counts as one. And the FTE analysis, as we currently know it, I fully expect this to be clarified in the next few weeks. But right now, if you look at the IRS definition of FTEs, 2 part-times means 1 FTE. So again, that's important when we're calculating our forgiveness element, the numerator. We want the numerator to be larger than the denominator. So when we're calculating average FTEs during the 8-week period, again, if you have part-times, 2 part-times equals 1. And again, the objective is, and if you look carefully at the statute, there are 3 different denominators you can use. The numerator is one thing, but there's 3 different types of denominators, and you can pick which one best is suited for you. Like for instance, the options are, I always use the one from February 15, 2019 to June 30, 2019, and take the monthly average. That is the easiest one, but the other on the other side, you could use the average FTEs per month that you employed from January 1, 2020 to February 29, 2020. And if you happen to have you're a seasonal employer, you take their average FTEs employed per month from February 15th to June 30th. So obviously you want to pick the lower one of the 3 options that you have so that you do not have to suffer any negative consequences when calculating how much of your loan can be forgiven. And we already talked about the 25% reduction in salary. But I think that answers the question, Chris.
Yeah, I think so. So another theme that we're seeing is does rent include leases of equipment?
We'll get, again, I apologize for having to say this all the time, but my current advice is yes. And rent expense for the rent for your facility, if you don't own it and have a mortgage debt on it, that interest component, and let's say you're just leasing space, I think that's rent. Obviously, the harder question is for the vehicle lease or clearly if you borrowed money to purchase the piece of equipment and some type of equipment financing, the interest component is clearly part of in the category of mortgage interest. It gets a little unclear if you're renting personal property equipment. There are references in the statute to mortgage interest on real and personal property, but it's a bit confusing. I do expect guidance on that. It'll be crystal clear in the next couple of weeks.
Okay, super helpful. And then another theme that we're seeing is, can we just go back to talking about a little bit about there are eligible expenses and then there are forgivable expenses. Can you just spend 2 minutes on like what you're allowed to use the proceeds on, and then how that's connected to forgiveness?
Well, the easiest example to understand is it goes back to interest. The interest component, for instance, if you receive a PPP loan and you have existing ABL loan or a revolving line of some sort that accrues interest daily, you can use the PPP proceeds for that purpose. There's nothing wrong with that. You lose the forgiveness feature, but you can do that, and you can also use it for employee salaries and things of that nature. I mean, the gray area comes into play when you get into the $100,000 cap. What part of the compensation for an employee making over $100,000 can you apply to meet your 75% payroll test? I'm taking more of an aggressive position that anything, the $100,000 cap only applies to salaries, commissions, etc. It doesn't limit if you have group insurance payment plans or you contribute to that person's 401k sick leave, parental leave, those kinds of things. Everything except FICA can be added, and I think at permitted payroll costs. So I think that as we get into there, it is not as broad as you would think, but I mean, the only real problem is you get into your certification. It kind of dovetails back to our application. You've got to say in your application that you have uncertain economic times. I think that applies to almost everyone, everyone on the call or everyone I've had an encounter with, and that you're going to spend the money to maintain payroll, mortgage, lease, and utility payments. Mm-hmm. That's what the government wants you to spend the money on, and as long as you do that, then you can again take advantage of the forgiveness feature. But in the example where I had the amounts were accidentally swept, or let's say you spend it on payroll that was incurred 3 weeks ago prior to your loan being funded, prior to your 8 weeks beginning, you can spend it on those. That's another example, something that you incurred prior to the 8 weeks, but you paid it during the 8 weeks, but the statute says incurred and paid during the covered period, which is the 8 week period. So those are other examples. I mean, it's not, like I said, we're not talking about fraud here. We're talking about people that are making accidentally, perhaps spending PPP loan proceeds on something that's not specifically set forth regarding the forgiveness component. And I may not be saying correctly, but I want to, that is a very small subset. And I think, Chris, your question is, yes, you can spend it on other things. But I think as best you can, I always try to recommend to people, try to spend your other sources of capital on things that fit outside of this narrow category, at least for the first 3 or 4 weeks. If we'll get down to the 7th week and you're sitting there with half of your PPP loan proceeds, or maybe in the 6th week, we'll start reevaluating it, but we'll have much more guidance that will help us. At this point in time, I'm really encouraging everybody to be very, very careful, and that as guidance comes in, we can loosen up the purse strings a little bit.
Okay, that's helpful. Another theme related to this discussion is when you have think about like an LLC structure where instead of the member being paid by W-2, they're paid guaranteed payments. Is the payroll cost, is that defined by that you're paying a human being, or does it have to be W-2?
I mean, it doesn't have to be W-2. It's a broad definition of payroll costs. I mean, you're getting into a little bit on the partnership tax issue. We're consulting with the tax attorneys now and trying to deal with the different types of scenarios that develop with sole proprietors, limited liability companies, and so on. I think if your question focuses on, let's say I own an LLC and we're trying to ascertain the LLC is going to make a PPP loan application, what amount would I include as my payroll costs? Well, I mean, it's most likely going to be the amount of money that I was on my K-1 that I had to recognize as income for the previous 12 months. Remember, you can go back 12 months, which can be March 1 looking back, or you can just take your 2019 numbers. Obviously, you want to take whichever one's larger, and to calculate your loan amount. So that's how I would do it. There is a discussion amongst tax attorneys as to how you determine that, if it's a guaranteed payment, if it's not, if it's, it's not really a salary, but it is compensation. And I think there's a viable argument if you just go to your K-1s on, LLCs, sole proprietorships, so on, and take that amount as your payroll cost divided by 12, to monthly average times 2.5, and that's your loan amount.
So down to 7 minutes left. 2 more themes that I'm seeing in the questions is, can you talk a little bit about timing especially for as it relates to like furloughed or laid off employees, and then reductions in salaries. So and one of the questions had the component of if you had somebody that was over 100,000 and with a reduction it became under 100,000, how then do you calculate it?
That's a little bit different. Obviously, just to lay the groundwork, if you have an employee that makes well over 100,000 and you reduce their salary, the 25% rule only applies to employees that make less than 100,000. So your question kind of gets into the gray area. Well, the person makes 110,000, but I reduced the comp by 25%. I think you're getting into an area that I'm encouraging people to make it easy for your bank to give you forgiveness. When you start doing things that are outside the lines, that based on what we have now, they may be clear in 2 weeks, but when you start doing things like that, you're just making it more difficult on your lender, which should be the same. You're borrowing the money, your PPP loan, from a person. That is the same person who is going to decide after June 30th, when you make your application for forgiveness, whether you are going to receive forgiveness. So, make it as easy as possible on them to give you that forgiveness. Please also note, and if you, in your loan documents, I will promise you that there's going to be provisions in there that talk about, well, if you can't prove it, then it's going to just be difficult. I'll just say that. I mean, it's just going to be difficult, and I don't know how else to say it. I want to make it easy on people to achieve forgiveness, and that's kind of what I'm getting at. Did you have any more? Can you hear me?
Sorry, I was answering questions by typing and was on mute. So we probably have 7 or 10 questions on whether you would recommend that businesses segregate the PPP funds in some way. Now, maybe that's opening a new bank account. Maybe it's just if they have fund accounting capabilities, which is generally like nonprofit and such, but or if they have maybe the ability to segregate it within their balance sheet. Like, what's your recommendation for doing that? Or should they segregate?
Well, I recommend segregating, don't commingle. I know money is fungible. Some lenders when I make these presentations, they kind of get upset with me because they don't want to have to go through the difficulty of opening up new operating accounts. I understand. But if you're dealing with current customers that already have 3 or 4 operating accounts, how difficult is it to open one more, is my response. And I want everybody on the call that's a borrower to remember, it doesn't say this in the statute, it doesn't say this in the guidance, but guess who's going to have the burden of proving that you're entitled to 100% forgiveness? It's you. And so what I'm saying is I want to do everything I can to independently verify and establish unequivocally that I'm entitled to 100% forgiveness, or whatever number I apply for. And these little things like, hey, the money went directly into this account and it went directly out for payroll costs, and everything is real simple and easily documented, and you're just going to make it easier on your lender to give you approval. I don't want to put lenders on the spot here, but yeah, I mean, technically your forgiveness is not really forgiven until the SBA says it's forgiven, but I anticipate it being one and the same. The SBA is relying on your lender to kind of do a good faith check of what you're doing. Occasionally, we've had situations where already on the calculation of loan amounts and the 500 employees, there were some mistakes made. And what lenders are doing is working with borrowers that make obvious mistakes to kind of get them back between the lines. So, long answer to a short question there, Chris.
Okay, all good. I appreciate it. All right, so I think the final theme that I'm seeing in the questions is payroll increases. So let's say, for example, somebody had 20 employees on March 1st or whatever the date, I can't remember which date you've been referencing, and then now is maybe they're an essential business and they're growing now, and so they get up to 23. Can they include? Obviously, they wouldn't be eligible for PPP for the additional employees, but could they still use the money for hiring those employees, and would that be forgivable?
I think those are all good things. So if, in that case that you've described some where the FTE, the numerator in our equation, is increased because your average number of FTEs during the covered period, the 8-week period, is increased. So your numerator is getting larger, and then you're going to pick the smallest denominator that we talked about. That will allow you to bypass or not worry about this forgiveness fraction that could reduce the dollar amount. I thought you were going to go in the opposite direction, where some people naturally said, look, I was going to trim down some fat in the business anyway. I was going to do this. It really doesn't have anything to do with the crisis. Yeah, but it's during that average number of FTEs during the 8-week period is your numerator, and then your denominator. So it all comes down to, if you're going to fire somebody, again, if you let them go for whatever reason, and you do it after February 15th, but before April 26th, let's say you have to terminate somebody, and so long as you hire them back by June 30th, 2020, it won't negatively impact this formula that I'm talking about, which would limit your forgiveness. So you gave an example where if the business was growing. I think you're unsafe territory there. I thought you were going to go in the other direction, which is the harder question, that I had less FTEs during the 8-week period than I had a year ago. Well, it's not bad. Hopefully your business is making more money because you've reduced your overhead, but you may not achieve 100% forgiveness. You may not, because if you get into that situation, I would say, well, let's take a look. Do you have any mortgage interest payments on real or personal property? Do you have any rent payments? Let's have any utility payments. And we're going to try to do other things as we get through the 5th, 6th, 7th week and document it. We're going to do everything above board. We're going to document it. We're going to be very careful, but we may have to adjust during the 8-week period. I'm getting a lot of questions from people that, hey, I can't spend 75% on payroll for one reason or another. And it's not clear what that means. It's guidance. It's obviously not the statute. So I'm at this point in time, I say, okay, spend what you can, try to meet the 75% test, because it's clearly in the guidance. But as long as you spend it on the 3 other items that are permitted by 1106, at least gives you an argument that you can seek forgiveness. Again, when they say guidance, it does say 75% has to be on payroll. That was the intent, but I have a feeling as people get down to the wire on the 8 weeks, remember, if you don't spend it, you can prepay it, there's no prepayment fee or anything like that. Or you just pay it, whatever's left, over months 7 through 24 at 1% interest, which is not the end of the world again.
Yeah. All right. Appreciate that. Last question before we part here. Ashish, if I think you're still on, do you think we'll see an expansion of this program? Is there going to be a PPP version 3?
I think right now, tough to say. I think based on what we're hearing, they'll evaluate how this one goes. But by all measures, this will probably run out pretty quickly, right? And I do think the government has shown a willingness to attack and address this much needed recovery. So hopefully Congress does act.
Yeah. All right, so we'll end here. I know we're a few minutes over. Appreciate you guys Ashish and Mike for joining on this, and appreciate everybody's attention here. Do note on the slides we're partnering with Blue Vine and Cabbage to Come here to help folks get through the program. I'll plug them again, and local banks for being able to get folks through the PPP program quickly. Many of them can answer some of the remaining questions, and then we have 120 open questions still, so I'll be looking to find additional themes and communications around that. But appreciate everybody's attention here, and for spending an hour with us, and mostly for being a supplier in the C2FO network. So everybody take care, and best of luck on the PPP program. Thank you.